Matt, what would surprise you more, 85 or 110?
Both are potentially in the cards here, Joe, just because the market is so volatile. But I think 85 seems the lower case scenario here, particularly given the backdrop, just what we've seen so far today and what we saw on Friday. So even though you have recessionary concerns, you have the super strong dollar making crude more expensive in every other currency apart from the dollar, and then the prospect of an Iran deal coming through. On the flip side of that, you have OPEC Plus telling us that they will cut production if there is an Iran deal. And then at the same time as well, and this is the kicker, Joe, is that European natural gas prices are so high. They've come off a lot today, but they're about $75 an MMBTU there. Super strong, that's about $450 equivalent for oil. And so you have strong oil demand that's going to be coming through in the months ahead here, simply because you'll see in Europe them switching from burning natural gas to burning oil instead.
All right, so if I understand you correctly, you're saying 85 is possible, but you think we're headed higher.
Yeah, and we just see that today, where you're seeing equity markets coming off with all of those concerns, but you have this underlying demand strength coming through. We've also got Russia sanctions as well. Those are looming on the horizon, coming in sort of early December there. That's going to be a chunk of supply coming off the market too. So really, although we've had all these demand side concerns, I'm sure China is a real concern. Their economic data is weak. Their crude specific imports, refinery runs are really low. But here in the US, things have turned around fairly well in terms of the price at the pump. Oil prices have dropped $25% from where we were, $25-ish. And we've dropped 25% on that national average as well. And so there's lesser demand side concerns. The whole picture for the oil market right now seems to be these supply side concerns from various different factions.
Matt, when would you expect, let's go out to 2023, because I'm trying to, everything that we talk about, transitory, not transitory, what's the average price of crude going to be in your view? Or give me a range for 2023.
I think we're going to be above $100 a barrel, unless, obviously you can always apply caveats to these type of things, Joe, unless we see really deep recessionary concerns. But the problem relies on the whole kind of supply side of this picture. That is the problem. Even in the US here, we're not seeing particularly strong production growth, even though we're seeing prices kicking around $100. So we're not seeing that strength really coming through in the US. OPEC Plus is really struggling, and yet we have a backdrop here where we're still emerging from the pandemic and seeing demand growth. If you believe IEA, we're adding about 2 million barrels a day of demand growth this year and continuing to grow going forward here. And so there's that kind of impetus here to see prices moving higher, as there is lack of investment in the production side of the picture.
So Matt, when you look at the absolute level of prices, if you expect them to stay high into 2023, what's the point at which they would spike higher and become troublesome in your mind to the rest of the economy, to the global economy?
Yeah, absolutely. So in dollar terms, just because, say, you see the euro at parity now with the dollar here, that is a concern because they're paying that much more for that barrel than they were 6-9 months ago or that. In the US, we probably had a good blueprint of this back in mid-June, where we saw prices getting up to $125. We saw that price at the pump hitting $5 a gallon. That's when we saw demand destruction really kind of kicking in. And so we've come off 25% because of those demand side concerns. I would make the case that that's the kind of level we'd have to see us get to again to really see demand side concerns kicking in again.